Ladies and gentlemen, good day and welcome to the Aditya Birla Sun Life Asset Management Company Limited Q1 FY23 earnings conference call. We have with us today from the management Mr. A. Balasubramanian, Managing Director and Chief Executive Officer, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Bhogle, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the management address concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone telephone. I now hand the conference over to Mr. A. Balasubramanian for his opening remarks. Thank you, and over to you, sir.
Yeah. Thank you for the introduction, and good evening to everyone for attending today's investors call. And I'm sure you all would have had an opportunity to go through the earnings presentation, which is available in the stock exchange and also in our website. Let me just give you an overview on the broad economy very briefly and the mutual fund industry in general. Then I'll come to the ABCD performance. The macroeconomic landscape, as is known to all of us, has been marked by fears of recession as well as geopolitical conflict. Economies all over the world have been witnessing inflationary pressures, which have led to the monetary authorities turning hawkish and rising policy rates across global markets. On the other side, supply constraints, rising raw material prices, along with increased cost of borrowing, has resulted in uncertain economic business environment across the globe. Against this backdrop, it is comforting to see the resilience shown by the Indian economy. Our PMI continues to expand. GST collections have been robust. Capacity utilization marginally has been rising. There is also a positive movement in terms of new project announcements. However, the economic uncertainty has been reflected by the volatile market, which is what we have seen in the first quarter of this year. The last few months have been challenging for investors globally, both on the equity and fixed income market. Indian equity has witnessed a sharp drawdown, but the Indian markets have been relatively outperforming the global markets on account of the economic resilience and the policy reforms continuation. And tightening liquidity conditions have forced foreign portfolio investors to be net sellers consistently since October 2021. The outflow in Q1 of FY23 have also been the highest ever outflow you would have witnessed from FPIs. However, the domestic institutional retail investors' participations, both the market directly as well as through the institutional, have shown confidence and also being a major buyer during the same time as the DIIs. From the broad debt market perspective, yields across the curve have moved up significantly at the start of the calendar year 2022 in anticipation of the successive rate hikes both in Fed as well as in India. In this kind of scenario, in this kind of uncertain period, with respect to the mutual industry during the quarter, the average assets under management for the quarter for the Indian mutual industry at 37.7 lakh crore as on 30 June 2022, as against 38.36 lakh crore as on March 2022. Though it grew by about to 14% from the last year, it also degrew from on a quarter-on-quarter basis on the basis of certain market fluctuation in equity, second certain withdrawals that are witnessed in the fixed income market. In a equivalent FY23, the mutual industries witnessed reasonably the net inflows in equity on a year-on-year basis continued. Significant proportion of inflows came mainly in some of the sectoral funds, large and mid-cap funds, flexi-cap funds, and balanced advantage funds. These are the existing categories in which money was flowing in. And owing to market volatility, the retail market average assets under management saw a slight dip from both the T30 and B30 markets during this period. As on June 30, 2022, the total number of mutual investors stood at 13.6 crores versus 10.4 crore investors from June 30, 2021, an increase of 13%. In fact, our customer addition continued to remain somewhat robust during this period. This continuous promotion of SIPs has maintained the status quo in the monthly SIP contribution. In fact, we have seen a flat growth in SIP in the last 2 months. The overall monthly SIP book was about 12,000 crores in June 2022, And the quarter-on-quarter new SIP registration has seen a marginal dip to close to about 59.5 lakh investors as of Q1 FY23. The total number of SIP counts for the whole industry was about 5.55 crores. The industry witnessed net equity sales around 59,000 crores, excluding index funds in Q1 FY23. However, there was a reduction in net inflows compared to the previous quarter. Broadly, the inflows came through the existing funds, as I mentioned earlier, using the large cap funds and other funds. Given the fact the first quarter of this financial year, there is no NFOs due to the regulatory restrictions. Therefore, all the money that came in, they came to the existing funds, including ourselves. The retail investors concentration in the industry continued to remain in excess of 50%. At the same time, the overall reduction in the fixed income assets due to the withdrawals during the fixed income interest rate volatile period also led to a higher dominance of individual asset mix, which is now close to about 58% of the total industry is represented as individuals. This we cannot say there is an increase in individual contribution, but it is largely on account of the drop in the AUM and the fixed income side due to the withdrawal. Therefore, the individual contribution has gone up by 1 or 2% compared to the previous quarter. Coming to the ABSL AMC performance, our total quarterly average AUM for the quarter ending June 2022 stood at 2.93 lakh crores, 2,93,000 crores, with a yearly growth of about 2%. Our equity AUM grew by about 14% year on year to about 1,70,000 crore size for the quarter ending June 2022. Our equity mix in the overall assets under management touched 41%, which again for us is one of the highest ever contributions we are getting in from equity in the overall asset mix. Again, one has to just keep in mind the marginal outflow in the fixed income also led to a marginal increase in the contribution coming from equity as well. As you stated, the customer acquisition continued to remain integral part of our strategy. We have added close to about 2 lakh new folios despite the uncertainty that we have witnessed during this period from a customer sentiment point of view. Despite that, we added about 2 lakh folios, which is now taking the total tally of our folios above 80 lakhs. And our short-term equity performance has seen reasonably good performance, turnaround performance across all categories. In fact, in our flexi cap fund and small cap fund, we have seen net equity inflows on the base of renewed interest on the back of performance as well as the focus that we are bringing in. We are constantly working towards leveraging the bouquet of existing products while launching new products to build size and scale. The increase of product per customer also has been one of the key agenda for us. We have been growing our retail franchise over the last few years with a special focus on building our market share and B30 market. Building SIP book size is our constant endeavor to ensure the customer stickiness as well as create long-term value for investors. As part of this drive, what we have launched in the last few quarters, such as Hargar SIP, such as Win-Win SIP, or multiple SIP, all of we are seeing some kind of traction at the ground level from the sales overall productivity point of view, also helping investors to make more investment on the base of the goal-based investing. As I speak, we also been now spending some money on terms of brand building, as well as creating more awareness about investing in the equity portfolios, on which I'll give an update in the next quarter results. I'll give an update given the fact we just launched in the last few weeks. All these efforts in terms of building our SIP have resulted in SIP book size moving from 816 crores in the month of June 2021 to about 898 crores as of June 2022. We also had about 2.8 lakh new SIPs registration during the quarter. Currently, we have about 32 lakh SIPs with us in terms of number of folios. Our multi-channel market activities to deepen our presence and market share has been showing positive results. And the virtual relationship model present, that we have about 16 touch points across India. We also activated close to about 900 distributors through this virtual RM model. Through our Sampark, which is again meant for activating more distributors and onboard new distributors as a first time for the mutual industry. There also something we have seen a success of adding close to about 1,900 distributors to our overall kitty to help us building our business next level. Customer loyalty and deeper engagement and service differentiation remains the cornerstone of our service to sales model that we have built in the last few years in order to increase the mind share of the customers. Currently, we have about 100 dedicated trained professionals to guide investors and service their needs in order to create a good mind recall, which ultimately result in market share improvement. With respect to overall mix between retail and institutional customers, we continue to have 48% of our assets contributed from retail investors as of June 2022. In the same manner, the contribution from B30 cities also have remained at 16%. Our focus remain in building retail both in B30 and T30, which again have been part of the integral part of our overall retail strategy in building our size. In addition to some of the initiatives we are now focusing on executing, we also introduced a theme called Sahayog, an initiative to further the cause of financial inclusion, the last mile person. We've been extending our support to our people, especially for low-income groups, by making them financially aware and setting them on the path of creating value through investment. That's something which is initiated as a new initiative for serving the growing needs of bottom of the pyramid people. And I'll give more update on this as we get more and more robust in terms of offering this product. As it is known on the alternate business, we had created a separate team of people about few quarters back to drive the alternate business as well as the passive segment. I'm happy to share with you that this segment has been progressing quite well and yielding gradual results in terms of showing good progress. Our passive product offering grew by about 6 times to about 12,695 crores in June 2022. Our emphasis on building passive strategy also gained momentum by way of launch of new products through ETF, fund of fund, and multiple index fund, including the passive, the target maturity fund on the fixed income side. Our existing passive bouquet have grown to 28 schemes, with about 20 plus more schemes getting added in the pipeline in the next few months. And overall customer base in this category also now grown to about 4,20,000, just short about 72,000 to 5 lakh numbers, which is 500,000 customer folios in the passive side. Also something I see as a good progress in terms of building our customer base in the passive side. On the offshore front, as we had an update last time, we had created a separate focus on creating a Greater India ESG engagement fund with the help of global money managers managing this fund. While he has been busy, of course, reaching out to more customers globally, we also received our seed funding from our Sun Life as a partner. They have given us a free seed funding of about $25 million. With this, on the basis of this success, we will take it to the next level of growth on this fund in getting more investors on base. We also have planned to launch under the Gift City for NRIs and the LRS investors. In fact, we are opening our office, is already ready. And once the inauguration is done, when the products are launched, we will actually go and launch some of the products for LRS investors to invest in overseas market. That's something is there in the pipeline. On the PMS and AIF front, in order to build our size, we had recently announced appointment of a senior person coming with 25 years of experience to drive the alternate business, who is also now on board. With his help, I think we will launch series of AIF in the PMS front. While doing that, we also launched PMS product, which is a market-linked debenture product, and also credit opportunities fund. We already launched. We are in the process of engaging with the distribution community, and hopefully we'll see some good of success. While building success on some of the new pipeline of AIF product, we also created some success on our real estate fund that we launched, the India Opportunities Real Estate Fund that we launched. We have received our first tranche of fund of close to about 190 crores. We are in the second fund launch closing, and upon doing this, we will take this to the overseas market with the help of the Pentel Greenwo for offering this product to the global investors. Now coming to the financial performance for the quarter, our focus continues to remain on achieving a robust asset mix of high margin equity assets along with the long-term debt. We would like to reiterate our equity mix is an all-time high of about 41% for the last quarter. We have maintained our operating revenue on PBT during the volatile market condition. During Q1 FY23, despite market volatility during the quarter, our revenue from operations remained close to about 303 crores as compared to 305 crores of the similar quarter last year, Q1 FY22. However, due to market volatility in the fixed income and equity market, the ANC treasury portfolio has seen a mark-to-market impact, leading to a decline in other income compared to the previous years. For Q1 FY23, our overall investment book, as it is disclosed, is close to about 2,217 crores. This money, of course, is invested in across mutual fund schemes, including the form of seed capital, Also, the defined capital which SEBI has given, and this investment had mark to market, therefore they tend to fluctuate, and depending upon the market conditions. That is what we have seen in the current quarter. Therefore, the other income was marginally lower compared to the last year or the same period. As a result of this, our profit after tax stood at 103 crores in Q1, despite our operating performance reasonably good. Because of the other income being lower, the overall profit after tax came to 103 crores, and that's something I did want to highlight it. With this, I would like to conclude and open the floor for any questions. I'll be joined by Prakash as well as Parag to take any questions that you may have. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, thank you very much for the opportunity, sir. So first question is on the market share trend on the active equity side. You did talk about improved performance in some of the schemes leading to inflows. But when we look at the market share on a QQ basis on the active equity side, it's still on a declining trend. So can you talk about what is your outlook on this side, and if there is any product launches on the active equity side as well which can help stem this? The second is a data keeping question. Normally you provide the SIP AUM, which was around 520 billion as of March 2022. Can you share the value as of June 22 as well?
Yeah, thanks, Anuj, for your question. With respect, of course, the market share, both on equity and overall, of course, our endeavor has been for quite some time to build the overall market share. While of course the initial the efforts were to ensure that we don't lose market share, at the same time building our market share in the existing product will remain one of the key focus areas. On the basis of this, this quarter, of course, we couldn't launch any NFOs given the fact that NFOs were generally not permitted by regulatory framework the first quarter of this year. While doing that, we stepped up our engagement in promoting some of our product on the existing side, such as the leaders in the respective category, such as large cap fund or flexi cap fund, or even the mid cap fund, where we have seen, and balanced advantage fund, where we have seen a significant improvement in terms of performance, and the product now is coming in terms of the reckoning list of some of these banking channel as well. But that's something again we are pushing it. Even the initiative we have taken to promote this as a category to be part of the overall core portfolio of every investor in order to track investments in existing funds, that's something which we are doing. And that there we have of course a target for our team to drive our existing schemes both in the form of SIP and the lump sums, that we need to actually increase the overall gross volume improvement, therefore leading to a net inflows and also leading to a market share stability and improvement marginally. With respect to the new fund offerings, we have been looking at launching multi-asset fund, and we already filed an offer document with SEBI, and hopefully that should come in very soon. Then once it is done, we will actually launch this fund sometime in the month of either August or September. August will be too early. Sometime in the month of September we'll launch this fund once we get the approval. But otherwise, as I mentioned, it will be a good mix of promoting our existing product and few NFOs. Also, the overall momentum creation, we see a great opportunity in the fixed income space. We have been quite successful in offering a product in the last 2 quarters, taking advantage of interest rates movement that we have seen. We became the number 1 fund other than government mandates that industry has got. In the target maturity fund, you can call it, or you can call it as a rundown kind of fund in the fixed income space. Today we have a leadership position of close to 10,000 crore size. We see a great opportunity to activate both the HNIs and retail and building the fixed income asset class. Therefore, we are launching some of our existing products which are a flagship product in the respective category, such as dynamic bond for our medium term plan. That's something again we have now put some kind of plan in place in order to drive 2 things. One, increase the participation in the fixed income space from both the HNI and the retail, given the fact rates are attractive. At the same time, encourage people actually to do STP and SIP from these schemes in order to build our equity portfolio from longer term wealth creation point of view. That is the way we have planned, and hopefully we should see some success on this phase, on these initiatives.
And Anuj, regarding your second question on the SIP AUM, it's around 46,000 for the June 2022.
Okay, I get it. And so lastly, if I may, on the distribution side, obviously distribution commissions last year were not very accretive for the AMCs. Have you seen some normalization happening there? And when you talk about the multi-asset fund awaiting approval, should we be seeing an improvement versus what we saw last year on the distribution side, or the scenario still remains the same?
As far as to answer this,
yeah. So Anuj, generally for all NFOs, we see a slightly higher brokerage in the first year. As current year, due to the embargo on various NFOs, the current year the commission are basically in the normal rate, which we generally keep on sharing with our partners around 60%, 65% of our total DTE.
So this is a decline from 85%, which we saw last year, right? That's a correct understanding.
There were a lot of NFOs last year, no?
Yeah. Okay.
Yeah, NFOs are slightly higher cost.
Yeah.
Okay. Okay. Got it. Thank you very much.
Thank you. We have the next question from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi, sir. Thanks a lot. Sir, if I wanted to calculate just equity AUM, but active equity AUM, then it is right to subtract there is a slide where you have actually given passive AUM that you have. So it is right to subtract that amount from 1168 billion crores, right? So I think that amount is around 1068 billion, which is active equity. Is that right?
No, Pranav. Actually, in that slide, there will be a debt index fund also. So
right.
It will not be correct to deduct that entire amount.
Right. So how to look at this? Like, if I wanted to understand the discretionary equity portfolio, how to calculate that?
So for active, you'll have to reduce from the whatever AUM we have, arbitrage and the equity index fund.
Right. Perfect. And it not the ETF?
ETF is not part of the equity AUM which we have given.
Yeah.
Okay. Perfect, sir. So that is one thing. Second thing is that in terms of the passive AUM, how profitable that line is going to be? Like whenever it reaches a certain size, can you just share the economics of that vertical?
Broadly, the approach that we are taking on passive, Pranav, is one, the B2 ETF, that is basically Nifty, Sensex, all of them would be contributing anywhere around 10 to 20 basis points kind of expenses, and ANC fees, at best, it can be about 10 to 15 basis points kind of thing. But if you have to take little, I think what we also intend to do, such as even last time I shared, which is the Nifty 50 equal weight index fund. That is a larger contribution, which could, where I'm able to charge expenses anywhere around 80 basis points, and therefore you get about 40 basis points kind of management fees will get. Our target is actually in the initial phase. Well, of course, we don't have much choice but to have presence in most of the key indices in the market, lower profitability. At the same time, our intention is quant-based kind of ETF, which can give us a slightly higher margins. But in any case, no ETF product, however good they are, it will be unfair to take more than 40 basis point of contribution to the overall AMC, given the fact that ETF is generally supposed to be cheaper than actively managed funds. That's why we are looking at building. So right now, the ETF should not be seen from a profitability point of view. ETF should be seen from the point of view of customer acquisition and giving fair to the customers to give alternate investment opportunities, or maybe a coexisting kind of product along with active funds. Therefore, it can be seen as the onboarding of customers as well. But as the size becomes a little larger in size as we move forward, and also we keep increasing our offering our product, therefore the contribution coming from ETF as a basket will show an improvement.
Right. Right. So in just a query about that. So there are a lot of Me Too ETFs. Like you have a Nifty 50 ETF, like there are 5 other players who have that. But if you see Western Hemisphere, where US and Europe, the ETFs have actually a large amount of stylized portfolios. And why we can't do that in India? So, for example, something like there are many technical ETFs as well. Or there is a style. So, for example, sector specific ETFs. Why can't we do that? Because no, not many people are doing that. Rather than having just Me Too ETFs, which is it doesn't matter for which is a treadmill, and everybody has to keep running on it.
Yeah. Basically, what you're saying is right now. I think one of the effort that we are putting in a customized ETF that we can create right now, like the way extended arm of Bank Nifty ETF is there. At the same time, the customized index that can be created on the basis of a model, or maybe taking into account the style of investing. That's something has been part of our process. At the same time, on the basis of our own assessment of some of the international product, given the fact ETF can be now even today, I can fit into the ETF product overseas, though there is no limit available for investing actively managed funds because the restriction of $1 billion. That we as a fund house also have launched some of the ETF that fit into the global market. That something is there. I think what you're saying is right. Our idea is actually use our expertise that we have internally, offer differentiated product using the customized index which can be created with some of style by bias or factor-based investing. That is our whole idea. But at the same time, in general, the flows that comes into the industry largely is coming into the traditional conventional ETF product. If one counts ETF as a category, say let us assuming passive and ETF category, let us assuming is close to 3,00,000 crores. Large component of these flows have come in the Sensex, Nifty, and to some extent banking ETF, more than that. So therefore, in our case, while we have to have a Me Too product, as I rightly pointed out, our intention is to build capability and offer this kind of product.
Right. Right. So, sir, just last question from my side. So when we say that your experience, you are focused on consumer experience, will not taking money or will stopping money if you think that there is there can be a once in a year provision in your funds where you can stop taking money if you think that market is extremely overvalued, because that will add ultimately to the consumer experience. So are you thinking from consumer's point of view holistically? Like, can you stop AUM? That will be one of the parts. Then obviously there will be many other factors of consumer experience, and consumer life cycle experience will be improved. So I just wanted to understand how holistically you are thinking about this. Thanks.
I think we have done it in the past, Pranav. I think when we saw about 3 years back, the credit opportunity in the industry is not going to be as big as what is being thought about. More than an opportunity, the risk in the system would increase quite significantly. In fact, we stopped taking inflows of high ticket, restricted inflows for investors, we restrict inflows. The same way we have done in the case of equity as well in Birla Dividend Plus in the past. Therefore, it is part of our strategy. Rather than when we feel there is a merit in doing that, even if it means it's going to come at the cost of not able to increase our size, and as long as it's going to benefit investors and give the right messaging, we'll be open, of course, to that.
Right.
Yeah.
Perfect, sir. If that perception gets created, then you will have an edge in distribution channel.
Yeah.
Perfect, sir. Thanks a lot. If I have any questions, I will come back later.
Sure.
Thank you. Before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hello. Audible?
Yes, please go ahead, sir.
So just a few questions from my side. The first is, if I just look at your distribution channels and split it between, let's say, banks, MFTs, and national distributors, and more thinking in terms of the equity flows that you're seeing through these channels. If you can give some color on the wallet share that is there across the channels or the contribution from the top 10, 20 players in those channels, how they are staging up and how it has changed, let's say, over the past 1 or 2 years. Second, more on the new fintech channels or the digital channels, if you can give some color on the flows for the industry. Has there been any trend changes, and how is ABSL AMC really positioned in that channel? And third, a data keeping question, if you can give the number of unique investor accounts as of June, and how it has changed YOY / QOQ.
Sure. Thanks, Dipanjan. As far as the channel concern, and I'll give you first the overall basis, then I'll give you the broad sense that we have from the distribution channel point of view. See, as it stands today, in the case of our overall 31% of our assets coming from on overall basis, including fixed income, coming from MFDs, and roughly 10% is coming from banks, and 14% coming from national distributors, and 44% is coming from channels. Of course, number looks larger because most of the institutional customers come directly. If you have to look at the same number for our equity, 17% comes from direct, and 15% come from IFAs and MFDs, and 18% come from national distributors, and 13% come from the banks. In fact, in the last 1 year, our contribution coming from banking has gone up from 12% to 13%. We have seen improved contribution coming from the banking channel. One, thanks to the NFO that we did last year. And in general, our products are being part of the recommendation list, both on fixed income and equity. Therefore, we started seeing contribution coming from the banking channel as well as national distribution channels. As you know, that the top 5 contributors in the banking channels, I am making an exception of SBI because anyway they don't deal with us. They don't sell any mutual fund other than SBI, therefore I'm not taking them. And the same case with the ICICI, does not sell in retail other than their own fund. If you have to knock off these two from the top, then it rest with HDFC Bank and Axis Bank and the foreign banks. These are the names which comes in. In fact, we generally have anywhere between 9 to 10% from banks like HDFC Bank, and Axis would be somewhere around 5.5%. That is a broad range in which we get. But otherwise, leave aside these two, some of the other foreign banks, we would have anywhere between 10 to 11% kind of market share. Of course, as we go down, the size also will be lower, though we will have a higher market share. So that's the broad trend that we have. In fact, the trend has been a little better compared to what we have seen in 2021. With respect to national distributors, we have seen improved contribution coming from the largest national distributors in the country, which is NJ as well as Prudent. We have seen increased contribution both in SIPs as well as in in equity AUM. These are the two, and rest of the places we have been maintaining somewhere around 8 to 9% kind of market share. So that's a broad trend. With respect to the number of unique investors, I'll just give you the number exact. 52.5 lakh unique customers, and this number compared to the last year would have gone up marginally. I think it was about 51, if I'm not wrong. 47. 47, it has gone to about 52.5 as a unique customer base.
Sure. So just one follow-up on your first answer, and thanks for the detailed clarification. So this wallet shares that you mentioned are on outstanding AUM basis or on flow basis?
This is on both.
Okay. And this will only be for the equity portion, right? Or this is like for the overall business?
Generally, I give it to the equity only. But if we have to add fixed income, a little bit higher in channels who sell fixed income, because not all distribution sells fixed income quite aggressively. Given the fact last 2 years there was not much of opportunities. But however, some of our products which are part of the recommendation list, let us say I'm taking the HDFC Bank is the largest distributor in the country as an example. 3 of our products is a part of the list. And we get almost about 14% contribution from there. If you have to look at only the fixed income. In fixed income, my contribution will be a little higher, given the fact that the products that we offer have got a longer term standing in terms of acceptance, and in general, the fixed income contribution from these channels would be at least 3-4% higher than the equity, except the volume of the fixed income will be lower than equity, as these the distribution houses focus more on equity rather than debt.
Sure. So just if I can, just kind of close the loop based on whatever you mentioned, it looks like across the top banking partners, across the top national distributors, your market share on the flow side, seems to be definitely higher than your outstanding market share on the equity business today. So if that possibly boils down to the fact that on the flow basis, either the market share on the MFTs or through the direct channel probably has been on the lower side. So, that kind of also brings me back to my last question, which is on the new fintech channels or digital channels, how things are stacking up. And if you can, kind of close this loop for me.
Yeah. See, as far as just to correct you on this, as far as the banking channel concerned, the market share that they have with us, what you said is right, will be marginally higher in terms of flows coming in. I will just give an example of Axis. The market share, what they have is an outstanding assets and what they give, it will be a little more than that. The more than that, whether it will have a significant impact on terms of on the volume would be marginal. That's one. Second, IFA channel in general has been flat for the industry. That's also something I think what you summed up is right. But as far as the fintech channel concerned, I think the whole industry AUM coming from the top 80 fintech partners we track, right from zero to grow to everyone. The total industry size, the number is roughly about 75,000 crores. 75,000 crores is the size, and we have roughly about 7.5% market share from this channel. But if I go into individual channels, my market share in some places could be lower, some places will be higher, depending upon what kind of tie-up that we have. For example, PhonePe as a channel is also equally a powerful channel, but may not be as big as Zerodha or Grow. But however, we do get 30% market share in PhonePe. I think it can vary from partner to partner.
Sure. I think thanks for the detailed clarification and all the best.
Thank you. We have the next question from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah. Hi, sir. Good evening, sir. Thank you for the opportunity. So, sir, just wanted to understand on the yield side. So, during the quarter, our share of equity AUM has increased marginally, and since and as you also mentioned that there were no low yielding NFOs. So, despite that, our revenue yields have declined on a sequential basis. So, could you highlight the reasons for the same?
Sure. Bharat.
So Lalit, if you look at it, it's a really marginal drop on last quarter to this quarter. If you see on the yield, even the YOY basis also there is a marginal drop. Even though the equity size as a percentage has gone up, the yield has compared to last year has gone down because most of the NFOs has come later part of the year over the first quarter. The second part is the movement of asset within the debt scheme has moved from various schemes which are slightly higher yielding to a lower yielding scheme, and the debt mix has slightly gone down compared to the last year, which has resulted some impact on the yield side.
Yeah.
Sure, sir. And so on the index fund, so as we understand that within the index fund, so about like 92% of it is contributed from the debt index fund. So could you highlight the yield difference between the debt index fund and the equity index fund, if there is any? And like going ahead, like if we have any products in the pipeline, so how do we expect the share between the index funds between debt and equity?
Sure.
So yields will be on the debt side will be in the range of around 10 to 12 basis, and on equity it will be on 15 to 20 basis range.
So what we have done, Lalit, as far as the fixed income target maturity fund concerned, we started off with 20 basis point expenses with about 10 basis point contribution coming to us. But as we started seeing more acceptance in the market, and as we started seeing this product is more relevant, even for HNIs and retail customers, we also launched one or two products with a higher expense of about 40 basis points, with the intention to have 20 basis points contribution coming from that segment, so that it becomes win-win for everyone. as the interest rates moved up. For example, we are launching our dynamic bond fund. While we may reduce the expenses, but expected increase in volume would actually lead to an increase in revenue. That's why we are building that space. But as the interest rates move up, definitely your ability to charge even fee based on higher, relatively higher. That is a model in which we are just looking at building.
Sure, sir. Thank you for the answer. And so just one data. So what were the ESOP expenses during the quarter?
ESOP.
8.5 crore.
Sure, sir. Thank you.
Yeah, thanks.
Thank you. Before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good evening. Thank you for taking my question. See, most of my questions have been answered. I just wanted to understand, what is happening on the fixed income side. We are seeing a consistent drop in market share, even there. And the other thing, this monthly SIP book that we get from the industry, this I believe is the gross number. I want to understand from you what is the real net inflow that we are seeing, and what have been the trends on this? Yeah.
Yeah. So with respect to your first question on the fixed income, the first quarter was pretty volatile from the fixed income point of view. In general, we saw a behavior from institutional customers to redeem from mutual funds and either go for fixed coupon bonds or fixed deposits or repay loan or move into the target maturity fund. That's why we have seen, therefore, some bit of, we normally enjoy high market share in the fixed income space from institutional customers, and due to that withdrawal in the volatile period, we would have seen a marginal dip. We still have about 10.9% market share, which is still pretty decent market share that we have. But having said that, that is not something which generally is a worrying factor. We as a fund house, we do have reasonably good confidence and engagement with customers in order to get that our due market share, which we historically have maintained. But having again said that, this space also the competitive landscape, some of them didn't have much presence in this space, but they also deserve to get some kind of contribution coming from the customers, also gaining some strength in this space. That's one. So as far as therefore that something was the phenomena that we have witnessed in the first quarter. But this is something I think once we launch some of our open and debt fund from HNI's point of view, we will see incremental additions coming from retail as well in the space there. And your second question on the SIP, last Prakash to give an answer.
But this second question on the SIP, the amount is the same. That's the inflow what we receive from the SIP book size.
So that is 9 billion, right? That is your. But is the industry number gross or net?
Industry numbers are the same. These are the comparable numbers with the industry.
These are okay.
Yeah.
Understood. So, got it. Thanks. Thank you for the answer.
Yeah.
Thank you. We have the next question from the line of Jignesh Shial from InCred Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Am I audible?
Yes, please go ahead.
Yeah, good. So, most of the questions have been answered. Just more like understanding it. We are seeing a bit of a dip from our contribution from B30 cities. Forgive me if I missed it earlier, but any specific reason for it that there is a bit of a dip that we are witnessing this time?
Yeah, I think B30 is good to know, yeah. See, B30 AUM, I think for us actually it's getting stagnated. It's not dipping as I would say. It's about 15.9, some of the numbers. We are stuck at about 16%. And I think the reason is a lot of this NFO that we did last year, if you recall, most of the equity money that came in last year through NFOs for the industry largely has come from equity, and fixed income contribution generally has been very, very negligible. Therefore, that has resulted in B30 AUM remaining somewhat stagnant for some of the incumbent players. At the same time, those who had these NFO launches, they would have had incremental contribution coming from the B30 market. That's one. Second is one fact remains, which anyway the access, as I mentioned, even the distribution update I gave, I knocked off SBI from my consideration. But if you have to look at their own the presence in B30 market, it is much higher than what the competition is doing. Therefore, to the extent we can see the number is getting stagnated. Otherwise, if I knock off that, then naturally our number look a little better. Of course, I can't knock it off. At the end of the day, they are part of the industry itself.
So are we facing competition even in B30, or I mean even ex-SBI is competition getting little tougher because most of the AMCs right now is focusing on deepening the penetration and all. Or I agree that more or less it is coming on equity and not on debt. But are we facing a competition getting built up already, or do you think there is enough scope still left for everybody to grow in this particular space?
Yeah, no. In general, of course, competitive landscape is getting better, no doubt. At the same time, given the fact that we as a fund house have been creating presence to the emerging market channels, looking at new markets on a continuous basis, and level of engagement that we have in the deeper parts of the country, which has got which can contribute to the equity AUM. At the same time, the persistence of these assets could be longer. That's something as a fund house we have been quite successful in building this market. Despite the competitive landscape is changing, I think we will remain extremely committed to build this business. That's something I'm not worried about that.
Oh, understood. My second question had been that we had been doing pretty good on the direct side. Even now, roughly around sourcing comes out roughly 42% if I see it up now. But it has been declining. Is it because of the debt fund which is seeing a bit of an adversity due to the external factors, or the focus has been reduced, or any specific reason for overall share of direct been reducing, or the contribution coming from the others is the reason why one should see that direct has been declining?
I think largely due to the debt. I think you rightly pointed out, largely to the debt. So of course, if I think my present number 13.5 lakh crore for the industry is dropped to about 37.2 or 37.3. That is largely on account of fixed income outflow. We did also seen about 29 outflow, about 16,000 crores. As that actually tilted the direct exposure to some extent.
Understood. And lastly, just third question from my side, not specific for Birla, but being a veteran in the industry, just getting a sense over here. We are seeing that overall, not for one fund, but across, yield had been compressing across, whether it is equity or debt or even liquid, and obviously the surge of passive has also been one of the reasons. But now with yields remaining stagnant for more or less at the lower end right now, and limited scope for further consolidation or further cut on the OPEX side, do you think we are almost going to see the similar kind of pattern for for the AMC in general, for at least a couple of years, till the time we don't see the competition, allowing the yields to move up? The overall sense I wanted from your side, not commenting specific on ABSL as such, but what's your view that how we can see that the profitability will be improving, the PAT yields would be improving from here on for the industry in general? Just if you can give some sense over it.
I will only put it in a simple manner on this. I think last few years, if you see, the industry has seen declining margins, declining expense ratio, which is linked to the size as well. At the same time, in general, the profitability has been improving because of volume improvement. I think industry dynamics will continue to remain the same way even going forward. The scale players like us have a large profit pool is coming because of efficiency, as well as the cost benefit one will get on the basis of increased volume. That continues to remain a big part of the strategy. Well, of course, even the new fund offering will come from smaller size funds. And as the size becomes larger for everybody, I think everyone will go through the same situations when it comes to the question of reduction of the margin and so on and so forth. But my own belief is, from a bigger perspective, I think we are more or less getting consolidated. Therefore, there should not be any significant pressure getting accrued to the industry, except the differential advantage one will have between the smaller size funds versus bigger size funds. That advantage will remain. That's created by the regulatory environment. Is not created by the competitive landscape.
Okay. Thanks for this, sir, and all the best.
Yeah. Thanks, Dinesh. Yeah.
Thank you. We have the next question from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah. Hi, good evening, everyone. So firstly, recently in the last few months, the incremental SIP accounts have kind of slowed down. Any thoughts as to is this a structural slowdown or is just linked to the markets, or what's the factors that are impacting this?
Now, which slowdown you are saying, Prayesh?
Hello?
Which slowdown? Which one you are referring to? Slowdown?
Incremental SIP accounts. That was opening of incremental SIP accounts. Yeah.
Yes. No, basically that's it's a function of market and function of how the past return generally works. I think even for the industry as well as for us, now having reached certain size and last quarter we saw a marginal dip in SIPs. Sometimes what happens is during the volatile market period, generally there is a tendency for people to stop the SIPs, and that's something historically we have seen. Again, they come back. While we see marginal dip, I mean, we as a fund house, having now built SIP to close to about 900 crores, now getting stabilized from last year it was 816 crores in the same quarter. Today has been stabilized at 900 crores. In fact, we have been aiming this number, how it can actually cross the 4-digit number, and for which what we need to be done. That something remains. Given the fact that SIP way of investing now is becoming, we are investing in mutual fund, most of the investors, and that's why I think we as a fund house also doing it. So the marginal dip in terms of what you're saying for even industry also seen a marginal dip. That's something I've always seen historically linked to the market volatility. But at the same time, there is a higher acceptance for SIP investing by the investors. Therefore, that's something I do not think as a trend reversal. It's more of temporary.
Okay. Got that. And secondly, sir, on the overall expenses for Aditya Birla AMC, is there any levers to cut absolute costs where, you have been talking about scale benefits, but is there a scope to cut costs anywhere which can help improve the profitability or, the PAT margins? Because it seems to be, would continue to decline at least in the near term. So what is any cost that can be controlled or can be reduced in absolute terms?
So Prayesh, on the cost, as you know, we have currently some hit on ESOP, which we keep on getting every year. As it is a dropping trend of 40, 30, 20, 10 over the 4 years, that cost will keep on going down over the period, and after 4 years that cost will go away unless we issue some new ESOPs to employees. So that is one cost. Plus wherever we are, we have been experimenting on a lot of digital way of engaging with people. So once that gets stabilized over the period, that may also look at some cost benefit we may get it. And and on one ABC, as we mentioned, on the consolidation of branches we are doing at ABC level will help us to save cost that is a smaller space compared to the current branches we are holding. So those are the areas currently we can see that there may be some cost reduction over the period, but it may not be very significant from on the overall cost basis. But those kind of small things which we will keep on doing and trying to explore.
Okay. And last question is on the other income. Over the last couple of quarters when the yields were rising, we have seen your other income kind of relatively stable, but in Q4 and in Q1 we've seen a negative other income. So what changed in the quarter that caused such a sharp reversal in the other income, and what kind of trajectory should we see out there?
So on other income side, generally we were investing most of the funds in the debt portfolio, but post the regulatory changes of the scheme in the game, we have started investing in the equity schemes of our fund. And currently in the market, as the equity has declined in the last quarter, we have seen a hit on that side. Plus on the debt long duration fund or the target maturity fund, where we have invested our funds to get a higher returns over a longer duration period because the investment horizon is much longer. We have seen a dip because the interest rate has gone up. So that has created some negative impact on the overall other income for the company.
Just to add to that, Prayesh, like the investments that we have made in the fixed income target maturity fund, here the intent is to hold till maturity. Therefore, you get the desired return on the basis of the yield that is prevailing at the time of investing. Well, that's the intent, but unfortunately, we have to mark to market during the interim period. So that's one which had an impact on this quarter. As Parag mentioned, in addition to regulatory-led limit investment that we have to make, we also have been, of course, seed some of the funds in building our ETF and passive innovation that we are doing in the product. We do, of course, seed the funds and to the extent of, say, 25 crores or 30 crores or 50 crores kind of seed fund that we do. But also sometimes go through this kind of volatility, which again, I would say is more of quarter-on-quarter kind of thing, but I don't think there any other thing that don't you worry about it.
All right. Thank you so much, sir.
Yeah.
Thank you. We have the next question from the line of Bhuvnesh Garg from Investec Capital. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. I have two questions. Sir, firstly, just want to know your thoughts from competition from smart beta platforms like small cap, and even broking companies are launching their own funds, and then some distributors are launching their own funds. So, how do you see competition coming from that side, and what your company is doing to mitigate that competition? And secondly, I just want to understand the revenue from ETF funds. For example, that how would that revenue will grow? For example, for a normal fund, the revenue will grow as the fund size grows. But how does in case of ETF your revenue will grow with the increase in fund size? Just these two questions.
See, as far as the fintech platform concerned, because we are not in that space, actually from the competition point of view. At the same time, we do evaluate options that we have in front of us in doing a proper tie-up with a small case in offering the back-end solution as well as ETF kind of product that we can do jointly. That's something we keep evaluating. Therefore, any broking platform provides a portfolio using some of these platforms. I think we do evaluate such platform from the point of view of offering ETF product. All the fintech platform, that is where we want to use it. Second, we also want to use the broking platform to promote our ETF from the point of view of giving to the customers, either from trading point of view or from investment point of view. That's something has been a part of our agenda to evaluate and make it quite agile and dynamic when it comes to the question of selection of product from an investor's portfolio point of view. This is two areas I see it. I don't see it as a competition, but definitely is one of the areas where we can look at some association with some of these platforms for us to build size. In fact, we do have tie with say Paytm, Kuvera, ET Money for the purpose of building customer acquisition in this model. When it comes to the question of ETF, I think the contribution is something I would assume one has to start counting from a contribution angle after say 1.5 years, given the fact that initial push would be more to create your presence visible, and at the same time it is made available in the platform for people to buy. Therefore, we actually made some investment assumptions either in the form of expenses to ensure that ETF gains some kind of traction. So that's the way we are building it. Therefore, the real contribution coming from the segment as it stands, as I explained to you before, on the index funds, on the debt index fund, we started off with low expenses, increased expenses as the size started getting accepted, as the size started coming in, started getting acceptance from the investors, from even HNIs. We felt that maybe margins can improve. So that is a model in which we'll build as far as the passive concerns.
Sure. Thank you.
Yeah.
Mr. Garg, does that answer all your questions?
Yes, ma'am.
Thank you. We have the next question from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, good evening, sir. Thank you for the opportunity. Most of my questions have been answered. Couple of bookkeeping kind of questions. First of all, the AUM, if you could share, I think you have shared earlier, but I missed that. So if you could share that number at the end of Q1. Second is on the tax rate, how to think about it. It was a tad bit higher this quarter. What would be the reason, and how do we see it going ahead for the rest of the financial year? And thirdly, in terms of other expense, given that this quarter there was no NFO and hence there was less marketing expenditure possibly, and going forward, would variable costs then come back into the cost structure? If you could elaborate on that.
Sure.
Swarnabha, SIP AUM is 46,000 for the Q1.
Okay. Thank you.
And on the question which you have asked on the tax side is mainly due to the deferred tax reversal on the impact of the other income on the losses which has happened in the current quarter. We are hopeful that it will come back to the same rate which we have been tracking for last couple of years over the rest of the year. And on the other expenses side, if you look at it compared to last year, it's slightly higher, whereas on quarter it is more or less flattish. Other expenses have mainly gone up due to a lot of activities which have started happening post opening of the economy post COVID, which has increased the traveling expenses, which has increased the event expenses. Plus, we had some events during this quarter on our investment voyage, which we used to do 2 years back before the COVID, which we have done in the current quarter, which has some expenses around that. And there are some impact on this rupee dollar having impact on some of the foreign exchange expenses, which has slight impact on that. So those are the main reason for expenses slightly going up compared to last year.
Okay, so you expect that rate to sustain, slightly elevated rate to sustain. Would that be a fair understanding?
So this will be more of a BAU, because if you see last couple of quarters, the range is in the similar expense range.
Okay, sir. And a follow-up again on the tax side. So the deferred tax credit that you have given had ideally kind of reduced your tax rate on a headline basis. So if I kind of do not factor in that, then your tax rate would be somewhere close to 33%. Normally, your tax rate is close to 25%, right?
Over the year, it will come back to the similar rate. That is what our expectation is.
Okay. All right. Okay. So that's all from my side. Thank you so much.
Yeah. Thank you.
Thank you. We have the next question from the line of Dhruvish Pujara from Mirabilis Investments. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just a couple of questions. So on the 2,200 crore prop investment book, what percentage would be invested in our in-house funds? And out of the total, what would be in the equity?
So on the overall investment, all whatever mutual fund investment which we do in our own funds only. There are some exposure to some of the direct debt investments which we have done earlier. And equity will be in the range of around 11 to 12%.
Got it. So, yeah, okay. And wanted to understand, like, when we invest in our own funds, like, how does the expense, as in the expense ratio which we earn on the prop book, does that, how does that get accounted? Does it flow through the revenue, or we don't charge? How does it work?
On our own investment, we can't charge the fees.
Okay, we don't charge. So there's no question of flowing through the revenue, right? And got it. And when I look at the TER, so let's say a scheme is worth 1,000 crore. Out of that, let's say 100 crore is invested by our own prop book. So how does the TER calculation, does that factor in that, or how does it? So would it bring down the TER because we are not charging on that 100 crore? That's the question.
So the fees will get reversed to that extent on that. So
got
fees
it.
will not get charged on that.
Got it. Okay. And wanted to understand how does the investment decision making works on the prop book. So like do we have a committee, or the investment team takes care of it, or like who are the people who are involved in the committee? So if you can give some thoughts on that. And how do we determine the equity and debt mix in that?
Yeah, basically, we have a team of people, internal people, comprising of investments, both in equity and fixed income and asset allocation fund. We do asset allocation fund, which again is purely driven by the committee approach, and where the CFO will also be there. And then they'll have a constant review and a holding period, and how much is the assets you need to invest as per the regulatory requirement, and how much we can go beyond that, and how much should be in the fixed income investment, keeping in mind the safety and so on and so forth. So that committee drives that decision. That we have proper policy, internal policy that we have.
Okay. Yeah. Thanks. Yeah.
Yeah.
Thank you. Ladies and gentlemen, that was the last question. Due to time constraints, we will now close the question queue. I would like to hand the conference over to Mr. A. Balasubramanian, Managing Director and Chief Executive Officer, for closing comments. Please go ahead.
Thank you, and thanks to all of you, and thanks very much for tuning in. And with this, we conclude our Q1 FY23 earnings call. Do feel free to reach out to our IR Prakash Bogle for any queries, if at all you may have. Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Aditya Birla Sun Life Asset Management Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.